I've actually been really impressed with how Bitcoin has traded over the last few weeks, because let's face it, everyone listening to this, you'd have seen the volatility or heard about the volatility in markets, and Bitcoin has held up pretty well.
Six is shaping up to be less about broad market beta and much more about selectivity. So we are no longer in an environment where everything rises together. Instead, performance is becoming more dispersed, and that means that what you own matters more than ever.
The question is really whether AI in China can remain a legitimate theme, right? I mean, it probably is. Some people may argue, but there is also the question of whether capital allocation discipline is there this time.
We are in a moment where price and value are deeply disconnected, and how you navigate that gap, I think that will determine the future return.
Hello everyone, and welcome to our latest quarterly investment outlook, brought to you by eToro. We've named it the Volatility Pivot, navigating uncertainty in an unstable market. It's been a fascinating first 3 months of the year, so we'll get into that very, very shortly. As always, please do take a moment just to have a quick look over the disclaimer, and remember, it is a marketing communication and should not be taken as investment advice, personal recommendation, or an offer of or solicitation to buy or sell any financial instruments. Today we are joined by the dream team. We've got Lale Akana, our global market analyst, Xavier Wong, our Asia emerging market analyst, and Javier Molina, our Spanish analyst and crypto expert. For those that are tuning in on YouTube, you can see them all waving at the screen. Very excited to be quizzed about the previous and upcoming 3 months. So Lale, we'll start with you first. Let's get into it. What has stood out to you so far in this incredible first 3 months of 2026?
Thank you, Sam. Look, I think the big theme is simple. Volatility is back and markets are becoming more selective, right? Year-to-date performance tells a very clear story. Energy is leading, with oil up to around 70%, while risk assets are lagging. Equities are especially negative, and more speculative areas like crypto and private equity are coming under pressure. So in our opinion, this is a diverging market, and that's important because it really speaks to the environment that we are in at the moment. It does feel like the market is in a correction phase, but really what it is, that it's a rotation-driven movement that's leading to this performance that we're seeing at the moment. We are starting to see pressure in key sectors such as software, financials, and banks that are pulling back. Housing-related stocks are weakening. These are obviously important parts of the market, and when leadership starts to crack, it typically signals a more fragile backdrop. Looking globally, the picture is also shifting. In Europe, markets have been under pressure, and rising yields, especially in Germany, are becoming a headwind. Higher rates are starting to crowd out defensive sectors, which is unusual as it adds to more volatility. In emerging markets, we are already seeing signs of, again, correction territory. China in particular remains weak. Upcoming earnings this week will actually be key in assessing whether that market stabilizes or that trend continues. Now, one of the more confusing elements in this market is gold. Typically, when equities struggle, gold acts as a safe haven. But right now, gold is also coming under pressure, even as volatility rises. Now, why? We think that because positioning has become crowded, sentiment is elevated, and importantly, real yields are moving higher. So that combination usually creates a more volatile environment for gold, and we are seeing a similar dynamic playing in silver as well. So in our opinion, how do we navigate this environment? I think that the key is to recognize that this is not a one-directional market. Again, volatility is elevated, leadership is rotating, and macro, especially rates and energy, is driving outcomes. Now, looking ahead to second quarter, there are several key catalysts that we're watching. Central bank decisions from the Fed, ECB, and Bank of England, the start of earnings seasons in the US in May, and important global policy signals, including China. Now, these events will likely determine how the market behaves in the second half of 2026 as well. So in our opinion, this is a market that requires discipline and selectivity, because until we see stabilizing yields, softer energy prices, and clearer leadership, we remain in an environment that is defined by uncertainty and higher volatility.
Thank you, Lale. Let's have a look now then at some of the drivers that we are looking for the rest of 2026.
Sure. I think the big picture is this, right? 2026 is shaping up to be less about broad market beta and much more about selectivity. So we are no longer in an environment where everything rises together. Instead, performance is becoming more dispersed, and that means that what you own matters more than ever. So first, earnings and capital discipline is what we look at. Markets are still being supported by earnings, but the quality of those earnings is becoming more important. Companies with pricing power, strong balance sheets, and disciplined capital are pulling ahead. Margins are no longer expanding broadly. They're actually stalling at the index level, which means weaker companies are starting to feel pressure. So going forward, in our opinion, this is really a stock picker's market where investors are rewarding cash flow durability, balance sheet strength, and efficient capital deployment. And second, energy markets and geopolitical risk. Obviously, energy is becoming a central macro driver again. We've seen how quickly tensions, particularly in the Middle East, surrounding key supply routes like the Strait of Hormuz, are feeding into oil prices, inflation expectations, and even cross-asset correlation. So we are moving into an environment where shocks are no longer isolated. They actually spill into different asset classes. So in that context, sustained higher energy prices don't just support the energy sector, they also create second-order effects like margin pressures and cyclicals and tighter financial conditions. The third factor we look at is tech and AI. AI remains one of the strongest structural themes in the market. Investments in data centers, semiconductors, and infrastructure, they all continue to drive earnings growth and capital flows. That will be the case in the second quarter of 2026. But here's the nuance. This is becoming a more capital-intensive cycle, right? So that means higher energy usage, higher materials demand, and more differentiation between winners and losers. So we're already seeing signs that high-growth, capital-light models are underperforming, while the more capital-intensive sectors, like industrials, are catching a bit. And finally, crypto. Our crypto analyst, Javi, is going to speak in more depth about this, but we think that the long-term story remains intact. Institutional adoption through ETFs and corporate involvements, they all continue to build a foundation for this asset class. But in the short term, crypto is very sensitive still to macro conditions, liquidity, and positioning. So volatility is likely to remain elevated until we get clearer regulatory directions, which we see as the catalyst for the next phase. So just to wrap it up here, Sam, QT is not about chasing the market higher. It's about navigating a more complex environment where earnings quality matters, macro shocks are more interconnected, and leadership is evolving. Therefore, selectivity, not broad exposure, is what will drive performance here.
Thank you, Lale. Bring it on, I say. For those that are listening on the podcast right now, remember the link is in the bio for YouTube, but we're just going to go through some of the survey results. We do this every quarter. It's probably one of my favorite parts of this webinar, podcast, whatever you want to call it, that we do. So I'll just read a few of those out, but if you're on YouTube, you can see it anyway. We asked which asset class did you all expect to perform best in quarter 2 2026, and a big difference from the December poll. 60% stocks perform best. That's down to 41%. The big mover to the upside is commodities, from 12% to 31%. In terms of sectors to perform best as well, tech went from 62 to 52. Energy went 21 to 33, so a big mover in the to the upside there as well. In terms of themes as well that people thought would perform best in Q2 2026, from December 41%, that went down to 30% for disruptive tech. Clean tech, though, did rise from 10 to 24%. In terms of regions as well, the US, and we'll come to you, Lale, in a moment about the US market outlook, the US went from 51% to 41%, whilst Europe, China, and emerging markets, Japan and UK, all increased slightly. The UK, there's a few of you out there that have a little faith, which is always good to see. But yes, remember, on the podcast, the link is in the bio for YouTube if you want to check all of those out in a little bit more detail. Lale, we'll come back to you then for our US market outlook.
Sure. I think the headline here is growth is still broadening, but we think that it's actually coming with more friction. And that friction reflects a deeper shift, right? As I said, it's where risk across energy, credit, currencies, and supply chains are no longer isolated, but they're becoming increasingly interconnected. We start with financial conditions. They're still technically accommodative, in my opinion, but the trend is clearly tightening at the margin. We are seeing higher treasury yields, rising inflation expectations, and a Fed that has less flexibility to ease. So importantly, stocks and bonds are becoming more correlated. Now that matters because it reduces diversification, so portfolios are becoming more sensitive to macro shocks. Now on earnings, the picture is still constructive in the US, but it's becoming more nuanced. Earnings growth remains positive. It's still supported by AI investment, fiscal spending, and still resilient corporate balance sheets, but breadth is uneven, and margins are starting to show some signs of stalling, particularly in more energy and labor-sensitive sectors. So again, selectivity is a key word we want to highlight here. This is no longer a rising tide lifting all boats. It's more about a selective earnings environment. Now that's also reflected in leadership. We are seeing rotation driven by positioning and geopolitics, with which what I would call a worst performers becoming best performers dynamic starting to emerge. Now, at the same time, we think mega cap dominance is starting to peak. The Max 7 still make up about 34.5% of the index, but they only contribute around 29% of earnings. A growing disconnect between size and fundamentals there, and that's the part of the market was driving a rotation toward value rather than growth. So just to wrap it up, Sam, the US market is still supported, but we are moving into a phase where macro matters more, leadership is rotating from growth to value, and concentration risks are starting to unwind. And again, the key takeaway is selectivity is becoming the dominant theme.
Thank you, Lale. Let's jump on our virtual plane from the US and land into Europe. How are we seeing things over here?
Again, I think, we're moving away from a broad-based rally in Europe toward a more selective market. Leadership overall, from a sectoral perspective, is increasingly concentrated in energy, defense, and defensives, which are benefiting from the current environment, while cyclicals are facing rising earnings risk, particularly from higher energy costs. I think one important dynamic to highlight here is growing dispersion across the region. Southern Europe, particularly Spain, continues to perform relatively better than other core countries. And that is helped by stronger bank performance and more resilient domestic demand. In contrast, core markets like Germany and France are lagging, reflecting weaker industrial momentum and greater sensitivity to energy costs. So this is no longer a uniform Europe story. It is increasingly a regional and sector selection story. At the same time, positioning is, again, clearly shifting toward defensives, again, looking just as a broad sectoral leadership here. Sectors like banks, defense, healthcare, they're acting as stabilizers in what is now becoming a more uncertain growth backdrop. So this aligns with the broader shift that we're seeing globally toward quality and resilience over cyclicality. So energy is a key swing factor here. It remains supportive for exporters and energy-linked sectors, but it also simultaneously puts pressure on margins, particularly in industrials and other energy-intensive areas. So that's why we're more cautious on autos, broader cyclicals, and parts of tech, which we think are exposed to both cost pressures and softer demand. So what needs to happen for Europe to reaccelerate? So at this point, I would say that valuation-driven movements have largely played out, and really the market needs to see earnings delivery to take the next leg higher. So mid-single-digit growth is still expected, but it's fragile, and without earnings upgrades, leadership could continue rotating, and overall upside might be more limited.
Amazing. Thank you. For those that are on YouTube, we always welcome any comments as well. Let us know your thoughts on Europe, on the US, on the poll as well. Really interested to hear what you all have to say. We're on our virtual plane now, and we've just landed in China. So, Xavier, welcome to your first quarterly outlook. How are you seeing things at the moment?
Hi, Sam. Thanks for having me. So I want to start off with China, right? In fact, I think the headline numbers are not that bad at all. China, in fact, they posted a record $1.2 trillion trade surplus in 2025, which I think was primarily driven by a deliberate rerouting, as we saw how demand in US dried up, right? So because of that, we also saw exports to Africa grew by 26%, to Southeast Asia by 13%, to Europe by 8%. And I think that paints us the picture that China as a country is really adapting well. But there's also this point that if we dive a little deeper, then a lot of questions start to surface. So interestingly, at the National People's Congress in March, China actually set its 2026 GDP growth target at between 4.5% to 5%. And this is the first time since 1991 that the official target has dropped below 5%. And also, it's the first time since they used a range instead of a single number. I don't see this as a small detail because it signals to all of us that even Beijing isn't fully confident about what the year ahead holds for them. I mean, if we just look at China's factory prices, which have been falling for over 40 consecutive months now, and there's another point where around 70% of Chinese household today, their wealth still sits in real estate, right? And that market, as we all know, has been under sustained pressure for many years now, right? So people are not exactly spending. They're more protecting what they currently have, right? So in a way, the record surplus that we mentioned, I would say it's partly a reflection of an economy that is producing more than its own consumers are willing to absorb, right? So to a certain extent, we can also see these playing out at the company level too, right? Take for instance, Tencent. Tencent, their revenue is up 14%. They recently just released their earnings. Profit is up as well. The firm's AI investment is in fact turning into revenue. In other words, money is going out, but at the same time, it's also coming back, right? Alibaba, on the other hand, it's a little more tricky. It's a different conversation on its own because yes, their cloud revenue is up, but net profit is also down an astounding 67%. Though I'll put it across this way that it's important to note for Alibaba, they are kind of in the mid-cycle on a $53 billion AI infrastructure commitment. So a lot of these costs, they hit hard, they hit now, but the revenue will probably come later, right? Then again, we saw how both stocks sold off around $66 billion combined in the days after earnings. And I guess the market just isn't sending the same message to both firms, right? The last point that I'll bring forward for this point is how Chinese company earnings have compounded at 14% annually since 2002. And those are some really strong numbers, but at the same time, we also see how per share returns have consistently lagged, right? And that's really due to how companies' management, they tend to dilute shareholders' equities during moments of market excitement. I mean, we have seen it back in 2007, we have seen it in 2015, and now that we have a fresh wave around AI excitement, the question is really whether AI in China can remain a legitimate theme, right? I mean, it probably is. Some people may argue, but there is also the question of whether capital allocation discipline is there this time.
Amazing. It's fascinating, not just in the US and China, but all over the world, how investors are reacting to those AI spending numbers. And we need to go from AI hype to AI revenue. And maybe this is the year that we start to see that. A quick flight now, Xavier, to Korea and Taiwan. Let's talk through it.
Yeah, so Korea and Taiwan is interesting because I think some of us may already know, right? Korea came into 2026 on a high, and it really came down to just two names, which is Samsung and SK Hynix, right? Because together, these two companies, they form nearly half the Kospi by weight. And both companies were riding the HBM wave, which is your high bandwidth memory chips, right? And these chips, they are the center of every major AI data centers built. In fact, SK Hynix, they posted an amazing 58% operating margin just in Q4 alone, actually, in fact, exceeding even that of TSMC. Of course, then much happened, right? All we see it crossed $100 per barrel. The Middle East tension escalated, and Korea got hit bad. Korea imports, virtually all of its fuel. So when an oil shock happened, then it triggers the exit of foreign capital. We also saw how Kospi recorded its worst single day drop, right, on record. So we are talking about over 12% in one session. Circuit breakers were introduced, and trading was in fact halted 3 times in the month, never seen before. So this also brings me to my point on Taiwan, right? Because which is the whole point of this slide. You see, for Korea, volatility was very specific to memory, which in our view, is a market that reprices very fast and is acutely exposed, especially when macro conditions shift. Taiwan, on the other hand, their foundry exposure, they run on, I would say, a completely different model. We are talking about multi-year contracts that already have their prices locked in, right? Both foundry and memory, they are very central to the entire AI infrastructure globally. But I would say Q1 made it very clear to all of us that not all semiconductor exposure is created equal. But then again, despite everything, the Kospi is still up over 20% year to date. So we wouldn't exactly call the earnings cycle broken. But when gains are concentrated in just two names, two stocks, then so are the drawdowns. And that's perhaps the lesson, Korea handed to all investors this quarter.
Yeah, absolutely. Let's talk emerging markets now. And for those who were tuning in earlier with the survey results, emerging markets was up slightly in terms of regions people expected to perform best from our December poll. Just a reminder, that went from 17% to 20%. So there'll be a lot of people, Xavier, listening to this very keenly. How are you seeing things at the moment?
Yes. So if I were to pull back to the broader emerging market picture, right? I'll put it across this way, that thankfully the worst didn't happen, right? Because emerging markets, they held up better than feared. And a lot of that has got to do with how China rerouted. But here is what we think fundamentally changed. And this is the hard truth. That tariffs, they are no longer being viewed just as your simple trade instrument. They are more and more used as a sort of political tool, if you were to put it that way, right? We see how China and Mexico, they were targeted over drug policy, Brazil over court ruling, and even India got hit with a 50% tariffs, partly because of their Russian oil purchase, right? So the risk of being targeted, it no longer just tracks a nation's trade surplus. It really tracks their political alignment as well. And to us, that's a much harder variable to hedge, right? Because out there is no trade model that can really fully capture it. And within the emerging market space itself, as you know, China continue to reroute its export capacity, and those include your cheap Chinese goods, your EVs, your electronics, etc. These goods are flowing into other emerging markets. And that is, if you think about it, a real competitive headwind for countries that are trying to grow their own manufacturing base, right? Of course, you have countries like Vietnam, who benefited from supply chain relocation, right? But you also have countries like Brazil, whose steel industry is really feeling the pressure. So we need to acknowledge that the emerging market space is not just one trade, but it's an entire universe on its own, right? And which brings me to my next point of, we think the most compelling pockets we see right now really sit outside all these noises entirely. So I'm talking about maybe your ASEAN digital economy, right? So companies like Grab Holdings, C Limited, based in Singapore, right? And just fintech platforms around them that are generating real revenue and user growth. Even better, these growths are centered almost entirely on domestic and regional demand. So in a sense, they are not caught in the US-China crossfire, yet still priced with a full emerging market risk premium. The market hasn't caught up with what's being built there right now, and in our opinion, that is perhaps a space that's worth a serious look.
Amazing. Thank you. And again, for those on YouTube, let us know your comments as well. Do you agree? Do you disagree? Let's get that conversation going. Xavier, thank you very much.
Thank you.
I know there will be some people that would have been tuning in just waiting for this particular section. Xavier, let's talk about crypto.
Yes, hello, how are you? So I think crypto is not longer a bet on the future. It's already being used for payments. Stable coins are processing more than $100 billion daily. Second, capital flows and financial infrastructure, real world assets, tokenization, and rails like the JP Morgan coin. So the most important point now is that we are in a moment where price and value are deeply disconnected. And how you navigate that gap, I think that will determine the future returns. So if we analyze what is happening, so the 4-year cycle is live. I was thinking that we were in a different cycle because of the institutional flows, because of the treasuries companies, but so far what we have seen is this 50% drawdown that is normal in this kind of cycles, but there is a huge difference. And the difference is who is behind these new movements, because we were used to have retail, so huge volatility, 75, 80% drawdown, so really extreme movements. And we have now is something different. The cycle is live, and we are still trying to find where the bottom is, but there is a huge difference. ETFs are there, the asset managers will arrive because we have the Clarity Act in the US that I'm going to just to give you some details, but at the end, the cycle remains, but the players have changed. And this is really important, thinking in the future, thinking in how to navigate this crypto asset. So if you go to the next slide, and if we try to see what is important, I have to say that first we have the Clarity Act in the US. I think that the stablecoin yield is not going to happen, but it's going to be the first time ever that we have a clear law in the US to say what is a security token and what is not. And crypto will be defined as a commodity. So this is really important. Why? Because then we have new institutional clients entering into the market. Just check this data. If the allocation in the global portfolios move from 0 to 0.20%, this is huge. It's a lot of money flowing into crypto as this alternative asset. And this marginal buyer, I think, is really important because, as I said, it's not retail, so it's institutional, and this is really important. But what really matters is this new infra that I was telling you. First, stable coins. I mean, we are clear that payments, settlements, they're gonna work as a global liquidity layer, and the important fact here is which blockchain are we going to use? So if you check the data, as today, Ethereum is concentrating more than 50% of this global volume. This gonna be the winner? I don't know, but that's the thing, that's the data that you have to check in order to understand what's going on with stablecoins. Second, the tokenization of assets. I mean, that's clear. Trillions of real world assets are moving on chain. Stocks, mutual funds, bonds. So is the traditional finance coming for sure 100% warranty to the on-chain market? So we are changing the rails, and this is important because there is a lot of value creation here, and that's why I was saying that there is a lot of value everywhere, but prices are really depressed. The sentiment is really low. People is trying to see if we're gonna go to the Bitcoin realized price. By the way, if you check the average cost basis that all the 20 million Bitcoins were buy and sell, were buy, is around $55,000. If you check the ETF, which is the average cost basis, we are talking about 7% of the global supply, 1.5 million Bitcoins are already held by the ETF. This average cost is around $80,000. And if you check whales between 100 and 1,000, this average cost is around 68,000. Now price is around 70. So this is important because it shows you where the interest is, where the flows are going, and these kind of levels. Now that you are going to explain technical analysis, I think that you have to mix with this technical analysis because on-chain data and price data is really important in order to navigate this ecosystem. Finally, I think that it's not longer about crypto assets, it's about the control of the financial system next layer. What does it mean? If we go on-chain, who is going to be the winner? It's going to be Ethereum, it's going to be Solana, or it's going to be private, because there is also risk here. If we go to the Canton network, so what's going to happen with Ethereum? So I don't know, but that's the important data that we have to analyze from now on, because as I said, and I finish here, this difference between value and price has never been so extreme. And this is a good opportunity just to think about that, just to analyze, and just to try to discover which is going to be the next layer for the financial system that is arriving to the crypto markets. That's it, Sam.
Xavi, thank you as always. Still coming up after we just have a quick look through the chart, we'll do the investment outlook, and then we've got 6 Q&A questions for our analysts. I've actually been really impressed with how Bitcoin has traded over the last few weeks, because let's face it, everyone listening to this, you'd have seen the volatility or heard about the volatility in markets, and Bitcoin has held up pretty well. I think quite interestingly, I'm just going to take us back to earlier of this down move. sort of into late last year. You can see we broke 1.7. That ended up being resistance, was previous support. We then found support on 97,000. That turned to resistance. We had previous support on 75 last week. That turns to resistance. So the market clearly cares about these levels. So I think for those people out there that want us to move higher, and I imagine there's a lot of people, but those that want that confirmation, a daily or weekly close above 75, 76,000, I think would give people a lot of confidence that maybe the low could be in. At the moment, between the 200-week moving average and that 75, 76,000 is kind of just chopping about. But what I would also say is the recent lows have been getting higher. And if, sentiment does start to improve and we can get a close above 76, I think investors and traders around the globe will be pretty happy. What I would say, though, is if obviously sentiment does sour and we start to move back down to that 200-week moving average, that would be the first time we officially test that since August in 2023.
And Sam, just a few points here. You check your points, your technical analysis, and you check the on-chain data that I was just talking about. The realized price, so the average cost basis for all the Bitcoins are close to 55. So it's close to the moving average.
Yeah.
And if you check the ETFs, it's 80,000. So it's a bit okay. Yes, it's on the ups. It's so far away from your point there, but it's interesting because this is gonna be a resistance level. So if the price goes 80,000, are the ETF holders starting to sell or not? So that's the kind of questions, and that's why I think it's interesting just to mix the on-chain data that is transparent, free for everybody. Just go on Google, on ChatGPT, and just ask for it and check with your technical analysis. And I think that this is key for all the investors.
Completely. And also, I think there's a new tool on YouTube where we can add a quiz in. So for those out there that do see the quiz pop up, a little question: where do you see Bitcoin trading at the end of the next quarter? And then we'll review that in the next quarterly. Right, Lale, back to you now for our quarter 2 2026 investment outlook summary.
Thank you, Sam. So look, as we look into Q2, I think the key theme is really, again, a shift from broad beta to selectivity, with diversification, sector rotation, and selective hedging, again, becoming increasingly important. So starting with equities, our long-term view remains constructive. I think, again, as I said before, structural drivers like earnings growth, AI investment, and capital discipline, they continue to support the asset class. However, leadership is broadening beyond mega caps. We are seeing a rotation away from that mega cap concentration toward value, defense, and sectors more closely tied to the real economy and capital spending cycle. At the same time, again, we've moved US growth sector, EM Asia, and Europe to a more neutral stance. Here, geopolitical uncertainty, particularly around ongoing conflicts in the Middle East, it is creating near-term volatility. So if we see a resolution or de-escalation, we will become more comfortable upgrading these regions back to a more positive outlook. On the thematic side, the AI story is evolving. We are moving from sort of like a hype phase to a build-out phase, if you will, where capital is flowing into infrastructure, into energy and semiconductor supply chains. Now, that shift favors more capital incentive sectors or the more asset-like growth sectors. I think in this environment, we need to talk about hedging as it's critical. In the short term, we like energy and inflation-sensitive assets as protection against ongoing geopolitical risks and price shocks continue. So energy markets, they remain a key transmission channel for inflation and cross-asset volatility. Now, real assets in general, they are regaining strategic importance more broadly. Over the long term, commodities and gold, they provide diversification to portfolios. Now, that said, after a strong recent run, we expect continued volatility, particularly in gold and silver, which is why we maintain a more neutral stance in the near term. More broadly on commodities, we are constructive, especially given supply constraints and geopolitical dynamics. We recognize that this is an asset class over the long run that warrants a balanced allocation. Hubby talked about crypto, just be very brief. Momentum has stabilized, it remains range bound, yet the long-term story remains intact. I mentioned before, institutional interest is still there through ETFs, through corporate involvement, which continues to build a foundation for the asset class. In the short term, crypto is very sensitive to macro conditions, liquidities, and positioning. On the rate side, higher for longer yields remains a key theme, and it's back with increasing geopolitical uncertainty. Energy shocks and rising term premia basically continue to put upward pressure on yields. That is true for the US, but across other regions as well, definitely going on in Europe, which limits the traditional defensive role of duration, right? So that brings us to cash and treasuries. Cash and just in general, short duration assets, they still provide optionality in a volatile environment such as this, allowing investors to stay flexible. We particularly think that instruments such as T-bills and other very short-term yielding assets, they make sense here when you want to invest your cash. Hence, we have a neutral stance in cash here. Longer-term treasuries, however, they remain under pressure due to the yield dynamics that I talked about and obviously inflation uncertainty at the moment. While they can still act as a hedge in a more severe risk-off scenario, they are less reliable as a core diversifier in this part of the cycle as opposed to history. So just to summarize, we remain positive on equities over the long term, but in the short term, positioning is more selective. Hedging through inflation-linked assets and energy is key. Commodities, they offer near-term support, but long-term volatility and flexibility through cash remains valuable in navigating this environment.
Very helpful, Lale. Thank you very much for putting that all together. We're now at the back end of the podcast, of the webinar, and it's time for the Q&A. We get people to send in questions, and then I give two each to all of you. Xavier, we'll start with you. You know the rules. I explained them earlier. You've got 1 minute to answer each question. First question then. With all the US-China tensions and tariffs, is it still safe to invest in Chinese stocks?
So I don't think it's a simple yes or no sort of answer, because Chinese stocks, they are not uninvestable, to put it that way, right? But you have to be very selective. As mentioned earlier, right, companies like Tencent, where AI had already translated to revenues, then they are in a very different positions from those that are still sitting mid-spending cycle, right? So over here, I wouldn't even say the biggest risk that we are facing is tariff, considering just how well China has been able to adapt, right? The real risk, I would say, is that China has always, the risk has always been governance, right? Because historically, we have seen how when excitement builds around the Chinese markets, then companies have the tendency to issue new shares or cash out. And it's always right when at the peak of investor enthusiasm, right? So yeah, I think so the point here is there are still opportunities out there, but it pays to be selective and to know what you own and why.
Absolutely. I think the buzzword of this presentation we've done is selective, I think. 1 down, 5 to go. Javi, coming to you next. How should we interpret the emergence of Ethereum ETFs with staking in terms of market structure and investor returns?
Yeah, I mean, I think it's interesting because when you think on the staking, it means that as Ethereum has a proof of stake, when you have a token, when you have a Ether, you can put it to securitize the network, and that's why you get a yield. The yield now is close to 3%. So what happens till now is when we had the ETF on Ethereum, it was not included. But now BlackRock, they just issue one of these ETFs on Ethereum with staking. It's not 100% of the total yield, but it's something like 80%. So that means that Ethereum is not just a price bet. It becomes something that generates yield, and that's important for institutionals and for portfolios. And I think that is a real good add to the global assets in terms of these adoptions from the institutional side.
Amazing. Lala, your first question. If stocks and bonds are correlating, how should portfolios adapt?
Sure. First, let's see why they are correlating. I think at the moment they're largely driven by two forces, namely inflation and energy price shocks. Diversification isn't disappearing, but I think it needs to evolve. So we are seeing a greater role for real assets like commodities in portfolios that could provide diversification to stocks and bonds. Value-oriented equities with pricing power, they are becoming more important in this environment, and more active sector and regional allocation, as I mentioned before. I think the key idea here is that diversification is no longer just about asset classes, but it's really about different economic sensitivities. And that's what you need to take a look at when you're including these in your portfolios.
I love that. I've literally just written down, because I love the line, diversity isn't disappearing, but needs to evolve. I love that. Xavier, coming back to you for your last question. Oil prices are spiking and markets are volatile. Should I be moving money out of Asia right now?
Yes. So you see, the volatility is real, right? But so is the recovery. I touched earlier how Korea dropped over 12% in a single day, and there's every reason to be alarmed, right? But if you were to just zoom out and look at the bigger picture, it's still up 20% for the year, right? So we need to understand here that volatility doesn't equate to vulnerability, right? Yes, oil spikes, they create noises, but they also shake out nervous money, right? They don't change the fundamentals underneath, right? For the most part, I think Asia is still where a lot of real growth is happening. The way I see it, markets are now left with fundamentally good assets at lower prices. Asian equities, they were already relatively lower valuations compared to US peers before all of this happened, right? And now the gap is just even wider. So for someone out there, for an investor out there that's been thinking about diversifying, then I think it's arguable that this is closer to an opportunity than a warning sign.
Understood. Xavi, your final question. We've seen the NASDAQ and now the New York Stock Exchange moving towards tokenization. But what does this really mean?
Wow, it's fascinating, Sam. It means that we are moving from theory to reality. When major exchange like NASDAQ or New York Stock Exchange, as you said, are involved, it means that this is becoming part of the financial system. So tokenization is the present, and it's a radical shift that you can miss even from an intellectual standpoint alone. So it's not a question of investing, it's a question of understanding this radical shift. Everything on the financial market are just moving on chain, and that's important to understand and to navigate.
Yeah, massively important. Lale, our final question before the quarter 3 outlook that we do. Is the rotation away from mega cap tech sustainable?
I think that there are reasons to think that this rotation has legs. First of all, mega cap tech, as we know, has driven a significant share of market returns, But there's now a growing disconnect, if you will, that those companies that represent roughly a third of the index, but a smaller share of earnings, as I said before. At the same time, we're also seeing a shift in the type of growth the market is rewarding at the moment. We are, again, as I said before, we're moving from a more capital light, software driven cycle into a more capital intensive one. So these are companies that are infrastructure, energy, industrials, and it was sort of like a broader range of sectors. So that doesn't mean that the tech leadership disappears, but it becomes less dominant and more selective. So I would say rather than a full reversal, it's more a case of a broadening of leadership, which again fits that broader theme of increased dispersion that I talked about. So naturally, sectors in industrials, financials, and energy will benefit from that broadening.
Thank you very much. Hope everyone who has made it to the end of our podcast has enjoyed it. Like, share, subscribe, check out Digest and Invest Online. This has been the Volatility Pivot, navigating uncertainty in an unstable market. Many thanks to Lale, to Xavier and Javi. It's been an absolute pleasure, and we'll see you in 3 months.